Do you have yesterday's high and low marked on your charts at the moment? Chances are you don't. I am here to tell you those previous day levels are absolutely essential to be paying attention to. One of the most significant factors influencing price action is the previous day's high and low. These two levels serve as key reference points, providing valuable clues into the current market sentiment. Whenever I analyze price action, one of the first things I do is identify the highs and lows of the previous day. I use this indicator. What I do is look for price attempting to breach that resistance from the last session before getting rejected, or finding support right at the lows and bouncing. Add them to your charts, and you'll see for yourself how often the market respects them. These levels will give you an edge in spotting reversals and momentum shifts. And in combination with the VWAP, the high and low prices from the day before will offer excellent low-risk/high-reward trade points neglected by so many traders. So why are previous day high and low significant? Well, there are several reasons for this. First, they represent market memory. These levels represent the maximum and minimum prices reached by the market in the previous trading session. This information captures the collective sentiment of traders on that particular day, providing helpful insights into the market's current direction. These levels are also liquidity magnets. They often attract a high volume of buying or selling orders, as traders expect to see price movements around these key points. This increased liquidity can intensify price movements, creating both opportunities and risks for traders. Previous day highs and lows can also act as psychological obstacles for traders, influencing their decision-making. Many traders may be cautious about entering trades outside or inside these levels, adding to the potential for significant price movements. So each trading day leaves its mark through the highs and lows it hits. And other traders watch these levels closely as potential battlefields, whether the price could not break through resistance or find support before falling further. Dear friends, if you're looking for an indicator with a proven 80% plus win ratio, check out my personal TradeIQ toolkit. After years of trading and studying market behavior, testing hundreds of different indicators, I came up with a tool that meets all my needs. This indicator has everything for analyzing price action on a professional level. In my opinion, every professional trader who uses the TradingView platform must have this tool in his library. Even if you're a price action trader, this indicator can take your skills to a totally new dimension. The TradeIQ toolkit includes 7 different features: buy and sell signals with targets, multi-time frame volumetric order blocks, supply and demand zones, improved trend lines, trend dashboard, trend candles, and ghost order blocks. I made a full tutorial about this indicator recently. You can watch it right after this video. If you can't wait to try the TradeIQ toolkit, click the first link in the description and get yours today risk-free for 7 days. The memory of a day's action sticks around in traders' minds even after market close. That's why these levels carry meaning based on previous activity. You know that at that point, buyers showed up there to stop a drop, and sellers overwhelmed the rally attempts around this area. You need to have these levels on your chart and be ready to take action if price revisits that area. One of the most interesting things about using those previous day levels is how versatile they are. It doesn't matter if the market is trending up, down, or sideways. Those highs and lows from the session before are always providing clues. In an uptrend, it's amazing how often that yesterday's low becomes a rock-solid foundation. Price bounces right back up from it quite often. Of course, you'll often see some liquidity running below this level. Don't ever expect these levels to be respected by the pip. On the contrary, expect liquidity to hunt above or below these levels. Same thing on the flip side. When we're trending down, the previous high tends to act like a magnet, pulling price back down after any bounce. But it's not just trends. Maybe what I enjoy most is watching the magic in ranging markets. You'll see price bouncing between those two levels like clockwork, testing the high as resistance before falling back to find support at the low. No matter what kind of action the market is serving up, those past closing levels make for reliable areas to find structure. Scouting for breakouts gets a whole lot easier when you know the zones the market will likely run into are support or resistance. But maybe even better, you can find solid reversal plays even when things are moving sideways. The key is to stack the odds in your favor as much as possible. For me, that means looking for confluences on my charts. If I see price reacting to a day low and bouncing off a VWAP line, now we're talking high probability. That volume-weighted average price does a great job showing us those dynamic support and resistance areas. And it's always shifting based on how the price has traded recently. So keeping tabs on how the market interacts with those VWAP bands is a great way to spot reversals in the making. From studying the market over so many years, I've discovered some repeatable things about how price interacts with VWAP bands. In more volatile conditions when there's no obvious trend pushing up or down, I've seen time and again how reliable it is for price to bounce between that upper and lower band like pinball, just bouncing off of support at the lower line before stalling against resistance at the upper bands. That middle main VWAP line acts as a real magnet, whether pulling price back up or guiding it down again. And it also works like a charm in trends. You'll often spot price sidling along, respecting the middle VWAP. So combine the previous day's levels with VWAP. Here's how theory plays out in real price action. The way I see it, when those areas overlap, that's your high probability trade area right there. Think about it. If price is bouncing around a day's low and finding support at a VWAP band, you got yourself a perfect confluence zone to be snapping up some trades. Great odds the move will reverse in your favor. Same goes for resistance, when the market tests yesterday's high but then stalls right at a VWAP line. An ideal short opportunity. So always scout your charts for where those levels coincide. You can see this market was in a bit of an uptrend based on those higher highs and higher lows, but also clearly trading sideways between these established zones. So when price comes down and tests right at that previous day's low and bounces off the lower VWAP band, to me, that's a strong buy. Perfect area to short as soon as we got that touch of the confluence. This is an aggressive entry. As soon as the price reaches the zone, you enter a sell trade. But for those that are more conservative, you wait for some sort of confirmation, so waiting for a red candle bearish rejection is equally valid. I'm looking at a stock that has been trading sideways for the past few days, bouncing between the high and low of the previous day. Yesterday, it tested the low several times but bounced each time. This tells me that the level is providing support. Today, I see the price dipping again and getting close to the previous day's low. But this time, it's also lining up right in the lower VWAP band. I know from past performance that this stock likes to find support at the low. Adding in the fact it's now reaching both the low and converging on the lower VWAP, it sets up a lower risk entry point. If I enter long as it's testing this confluence zone, I can set my stop loss just below the VWAP area. This gives the trade room to bounce without risk of triggering the stop on small volatility. This market has been trending lower over the past week, with each successive day's low providing a lower low in the downtrend. And here, we saw a price drop which closed near the low of its range. This established a strong support point. The next day, the price spiked up but then rolled over at a resistance level from the prior day's high. It began descending back down from the upper VWAP band, showing sellers were active on those rally attempts. So when it reached the confluence point of the previous day's high along with the upper VWAP band, that was the moment to initiate the short trade. Knowing we are still in a firm downtrend, this setup gave a low-risk entry with a protective stop placed above both the resistance levels. This confluence of resistance signals to me that there is a high probability of a reversal lower if it reaches this zone. So the strategy here is a short position with a stop loss placed above the lower VWAP band. In this example, I see the market has bounced between the previous high and low, forming a sideways range. Then price pushes up to retest the high, but stalls directly at the upper VWAP band. This confluence of resistance made for a great short, since both levels were likely to cause a reversal. Here we have an uptrend, and I observe that the price is clinging to the middle VWAP line nicely. Then it dips to retest the previous low and bounces perfectly off the lower VWAP band. This signal at those stacked supports provided another low-risk long entry. Now we have downtrending conditions. Price was respecting the VWAP very well. So when it bumped up to tag yesterday's high, but rolled over at the upper VWAP band, it was an ideal short setup with converging resistance. I hope you see the potential of this trading strategy. It's not perfect by any means. Of course, you can refine your entries even more, using volume or even some smart money concepts. So drop that like button and watch the TradeIQ Toolkit tutorial by clicking this video right here.